these are the Unit 6 notes on insurance. So as we kind of talked about in class, we talked about what type of insurance that you think is most important: health, life, auto, and home insurance, and why. And you all shared some of your feedback on your thoughts. So let's go ahead and let's talk about some true or false. 1 in 10 Americans visit the emergency room each year. That is actually false. It's actually a greater percentage. It's 1 in 7. Nearly 80% of crashes and 65% of near crashes involve some form of driver inattention in the 3 seconds before the event. That is true. Inattention means doing things like on your cell phone, trying to put on makeup, doing your hair, yelling at your kids in the back seat. All of those are considered to be inattentive activities. Nearly 1 in 3 Americans will become disabled for 1 year or more before the age of 65. That is false. It's actually 1 in 5. And when they use the term disabled, they typically mean having some type of injury or illness that keeps them from being able to work. In the U.S., an automobile is stolen every 60 seconds. That is actually false. It is instead every 26 seconds. 70% of fatal bicycle crashes involve head injuries. That is true. That's why it's very important to make sure you're wearing a helmet. Using lap and shoulder safety belts reduces the risk of fatal front seat injury by 45% and the risk of critical injury by 50%. That is true. That's why there are the laws that enforce the use of seat belts, and the fact that you can be given a ticket, if you are pulled over and not wearing a seat belt. 16-year-old drivers have crash rates 3 times greater than 17-year-old and 5 times greater than 18-year-olds. This is true because 16-year-old drivers are not as experienced, and so they have a bigger likelihood of being involved in an accident than an older driver, even just the difference of 1 or 2 years. A disabling injury occurs every minute. This is actually false. A disabling injury happens every second. Alright, so managing risk is kind of what we want to talk about to begin this unit, and understanding what it means to manage your risk. So there's 4 things that you can do. The first one is avoidance. Avoidance would be avoiding any situation that might be dangerous to you. So for example, if you know that the weather is bad and it's snowing out and that you are not comfortable with driving in the snow, or you do not have to be out in the snow, avoiding being out there would help you manage your risks, reduce the risk that something could happen or you get in an accident. Reduction, that has to do with minimizing your risk. So for example, washing your hands would reduce your chances of getting sick, or wearing a seatbelt will reduce the chances of you being injured in an auto accident. Next would be retention. Retention has to do with self-insurance. So just doing something to prepare yourself for the worst case scenario potentially. So retention can be, for example, setting money aside in case of a future loss. So having something there for you in case that you've done your best to avoid and to reduce, but something still happens, having that money there to take care of that situation. And then the last would be transfer, and that has to do with shifting the risk. And this is kind of where insurance companies come into play. In insurance, there's typically, or any situation, there's a low probability of all losing at the same time, which is why there's an importance of having more than just one insurance company. We want to be able to have several different insurance companies so that they all have a chance to make claims as necessary. So there's 3 different types of loss that we're going to be talking about within this unit, and basically 3 different types of loss that can be insured: health, property, and life. We're going to start with talking about health insurance. Health insurance is the most important insurance to have, but it's also the most expensive. Reason why it's considered to be most important is because it is one of those insurances that no matter what, in most typical situations, you're going to use your health insurance in some way, because health insurance is not just about using your insurance when you get sick or something happens and you're injured. Health insurance also means preventative care, like your yearly well visits and checkups, and anything from prenatal care or just things like that that you do to make sure that you are healthy and that you're preventing yourself from having to use more insurance later. Okay, so that is part of the reasons why it's most expensive. So there's three different main types of health insurance. The first would be a PPO, which stands for Preferred Provider Organizations. They come at a higher cost, but they do allow for more choices. And of course, you always want to read the fine print. So if you have PPO, for example, you basically have the choice to go to whichever doctor you would prefer, or whatever it is of your choosing. Excuse me. With HMO, which stands for Health Maintenance Organizations, you have to go to a selected list of physicians for your care. And it is usually lower cost than a PPO. But one thing that does come along with that is a primary care doctor must refer you to specialists. So for example, you feel like you've injured your ankle. If you have HMO, you may have to first go to your primary care doctor, and then they would give you a referral to an orthopedic specialist that can actually examine your ankle and determine what kind of injury you have. If you were to have PPO, on the other hand, you would probably be able to just give that orthopedic specialist, a call and make an appointment and then go in to see them without having to go to your primary care physician first. Okay? And then HSA. HSA basically stands for a health savings account, and the advantage of it is that it has savings, tax advantage savings for any uncovered costs that your HSA does not cover. Okay, so a couple things about health insurance. Number one, most people have health insurance through their employers, typically through a group plan. So group health insurance allows several people to have insurance at what would be considerably a lower rate, because your employer goes to an insurance company and says, hey, we have 300, 400, 500 employees that need insurance coverage. What kind of rate can you give us so that we can provide this for our employees? And they'll come back and say, okay, well, since you have so many employees, here is what kind of coverage we can offer you. Okay, it's that whole strength in numbers in terms of being able to save money. Other things you need to keep in mind about health insurance is the Affordable Care Act. There is a question on the exam about both understanding group health insurance and also the Affordable Care Act, and it's basically a quote-unquote more recent piece of legislation. It's also known as Obamacare, that was put into place to help ensure help to give access to health insurance to all Americans. Okay. Some health terms you want to make sure that you understand. Pre-existing condition, that is an illness that you have before coverage. So for example, if you were diagnosed with having asthma and you have to change insurance companies for whatever reason, maybe you get a new job or whatever the case is, that asthma will be transferred to that new insurance company as being considered a pre-existing condition. Exclusion would be medical services that are not covered. That includes things like plastic surgery, or maybe you want to get the LASIK eye surgery for your eyes so that you don't have to wear contacts or glasses anymore. That would be considered a service that would be an exclusion, and you would have to pay out of pocket. Insurance typically does not cover those things because they don't see it as being a necessary service. Deductible, that's the amount that you must pay before insurance covers. So for example, maybe you went to the hospital and you have a bill that's for $1,000. Your deductible would be what you have to pay out of pocket before the insurance pays the rest. So if your deductible was maybe $500, you would pay the $500. Your insurance would pay the other $500. A dependent is an individual relying on someone for financial support. Now, in terms of health insurance, your dependent would typically be anybody else who's being covered through your insurance. So let me go to the next one and I'll go back to dependent. The policyholder is a person that is the purchaser of the policy. That is the person whose name is on the policy, who has access to it because they are affiliated with a certain employer or work for a certain company. Okay, so the policyholder would be the person's name who has the insurance. Dependents would be anybody that is a part of that policy, the insurance policy, because they are related to that policyholder. Okay, so for example, I have insurance through Joliet Township because I'm employed here, and then my husband and my child would be on my insurance as well as dependents. Premiums is a word just like dependent and policyholder actually that applies to any type of insurance. Premium is a set amount paid to the insurance company. So that is the amount that you pay, whether it be every month or every 6 months, that would cover the cost of you keeping your insurance. So when you do not pay your premium, you are not covered with insurance. Lastly would be copay, and that is a percentage of cost that the insured pays. So sometimes you'll go to the doctor's office and you'll see a sign that says copay due before visit. So your copay is whatever it is that you have to pay before you are seen by the doctor. Alright, next thing, let's talk about life insurance. Life insurance is most needed by young families with children, okay? Life insurance, a lot of times, sometimes people don't want to talk about it because it has to do with the unfortunate event of someone passing. Life insurance will allow you to leave money for your family members in order for them to maintain some of those things that they had because of the money that you were bringing in through your job or what have you. So that's why it's important with families with young children. On the unfortunate event that you were to pass, you want to be able to have money to leave for your children to use as they need it. Okay. Two different types. Term life. Term life provides protection for a specific period of time. That's hence the name term. So for example, if you have a term life insurance policy of 30 years, then from that time that you pass, and then for the next 30 years, your beneficiaries, which is another word for like your children or whoever that policy is left to, would be able to have that access to that insurance money for 30 years. After that, they no longer would have access. The other type is whole life. Whole life provides lifetime protection as long as the premiums are paid. So if you do pass and you have a whole life policy and your family is able to continue making those premiums, then your family or whoever the beneficiaries are will be provided with that life insurance for the rest of their life. Coverage for life insurance, the minimum should be that you have enough to provide for your family in the event of your death. The real minimum should be at least being able to cover your funeral expenses. But you also want to think of things like covering a mortgage or a car note or other major expenses that you had while you were living. Other important term is face value. That's what the policy is worth. So for example, if you have a $500,000 policy, that's its face value. That does not mean that once you pass, your family is going to be getting a check for a $500,000. The other type of value when you think about is your cash value. So that would be the value of your policy, the value that your policy will be worth once it's actually cashed in. Okay, so think cash value, cashing it in. So typically it's going to be less than the face value. And if you have any questions or want to know more about life insurance, Ambest.com has good info and can provide you with an agent to help you with that. And other thing to keep in mind is that a lot of times, oftentimes, your employer will actually provide you with some type of option of life insurance coverage as well. All right, let's get into property insurance, whether we're talking about home and auto, because they both kind of work within that same understanding. Property coverage insures against damage to dwellings and possessions. So if you we're in a case where you lost maybe items in your house because of a fire, property coverage would cover the cost of replacing those items. Liability, important word to remember, especially with talking about auto insurance. We're going to get into more detail in a moment. Liability protects you if someone is injured on your property and the legal cost of defending yourself. So if someone is is injured on your property, and it's because of something that you did, maybe they slipped on some water, what have you, your liability coverage will cover the cost of their medical bills for that person. Appraisal, that's the estimate of current value. Appraisal is the value of the policy. Appraisal, is the value of policy, should be for replacement value, so it can be rebuilt at current prices. So appraisal is done on your house and oftentimes maybe even your car to determine what kind of coverage and how much coverage you're going to need based on the value of your home or your things. Okay? Alright, so what determines the cost of that insurance? The type of coverage you have. Do you just have liability? Do you have more than that? We're going to get to that in just a moment. The size of your deductible. Remember that deductible is what you pay before the insurance covers the rest of the cost. Risk factor, where you live. We're going to talk about that in just a moment. The insurance company you use, available discounts as well. Okay, so let's move on. Other type of property insurance that you need to be aware of would be renter's insurance. Renter insurance covers the cost of insuring your possessions only. Some landlords will actually require you to have renter's insurance before they allow you to rent with them. Floater insurance, that is for college students, would be, well, an example of who would benefit from a floater insurance. It protects items wherever you take them, so it's kind of one of those things where even if it is not in your home, you can have those things as a part of your homeowner's insurance and still have that protection in case that item is stolen or damaged. Endorsement, that is an attachment to a policy, which basically would kind of be like attaching that floater policy, or it can also be an attachment to your policy for some more expensive things, like if you have a fur coat or expensive jewelry like a wedding ring or any other expensive jewelry or art, things like that. Putting an endorsement on your policy will cover the replacement of those items if you were to have them damaged or lost or something like that. Alright, let's talk auto insurance. Make sure you're listening very carefully because it can be somewhat confusing. So first level of auto insurance would be liability. Liability would cover bodily coverage, meaning coverage when you are responsible for an accident that causes injury or death. And it will also cover property when you are responsible for damaging others' property. So liability, the word liability means liable. So it covers things that you are liable for, things that you caused. Okay? So any type of medical coverage for a person that you hit in an accident, for example, or any damage you did to their property or their car. Liability does not cover you. Okay? Does not cover you. So if you're driving down the street and you cause an accident, your liability coverage, if that's all you have, will cover the cost of repairing the other person's car and any medical bills that they may have, but it will not cover damage to your car or any injury that you may have because of the accident. So then that next level would be full coverage. Full coverage would include liability plus medical bills for you. Okay? If you were involved in an accident and you needed medical coverage, full coverage will cover that. Collision, which is damage from my accident to my vehicle. And then comprehensive as well, which is damage to my vehicle other than car theft. A lot of times they consider this to be as a result of something other than a car accident. One of the terms they may even use is act of God. So maybe your car is parked outside of your house and a tree falls over it, causing damage to your car. That's considered an act of God. There's nothing you could have done to necessarily prevent that. And so comprehensive coverage will cover that. And then another coverage type you can have under that full coverage would be an uninsured or underinsured driver. So that would be if you are in an accident with someone who is not insured. The thing to keep in mind is that liability is required by law in Illinois. If you are driving and you do not have liability insurance or proof of at least liability insurance, you will get a ticket. Here's a couple did you knows. 1 in 5 16-year-olds has an accident during their first year of driving. Male teens are much less likely to wear seatbelts than female teens. Also, 7.7% of the guys say they never wear their seatbelts compared to 2.8% of girls. 6.2% of teens talk on their cell phone while driving. Not good, people, not good. 2/3 of all high school drivers speed. That's not good either. Injury claims and collision losses for cars driven by insured teens is more than double of cars driven by insured adults. So, when looking at insurance, what is the price based on? Kind of goes back to the previous slide about what price depends on. So, age. What does that mean? The younger you are, the more expensive it is to pay for insurance, especially male drivers, which goes back to gender. Males are more expensive to insure, not necessarily because they are women are safer drivers, but statistically, men are willing to take more risk than women. Your marital status. If you are married, they feel that you're going to be a safer driver because you're going to be thinking about other people. You're going to be thinking about your spouse as you're driving and be less likely to take risk. The type of car you have. So, for example, if you have a 2-door car, typically insurance is more because that is considered a sports car, which goes faster. If you have a faster car, they feel like you're going to be more likely to get in an accident. Same thing with red cars. Red cars are more expensive to insure because red is associated with being fast, and that color red also makes you a target. Okay? They use statistics and all that to look at these different factors. How often you drive also has to do with what the price is based on. The more often you drive, the bigger risk you have of getting in an accident, which would mean your price could be increased. Location, higher traffic areas are going to raise your insurance prices because there is more likelihood that you'll get in an accident. Your driving record, less tickets you have, the lower your insurance. More tickets you have, the more you pay for insurance because you are considered a risk because of that driving record. And then also your claim record. Claim would be when you actually have gotten in an accident and you made a claim with your insurance company for your insurance company to pay for whatever damage has been done to your car or what have you. So the more claims you have, the more expensive your insurance may be. Your credit history is coming back to haunt you, I guess you can say. It's one of those things, once again, it's really used to determine what type of person you are, how responsible you are. So if your credit is good, then your insurance rate potentially would be lower. All right, so what can you do to keep the cost down on insurance? You can choose a higher deductible. Typically, the lower deductibles would be $250 and $500. You can have a deductible as high as $1,000, but if on a loan, meaning that you are paying off your car, you have a loan, it's being financed, that loan company or bank may demand $500 as the most you can have for your deductible. Also, make sure you shop around. Sometimes even using internet independent agents could be a benefit because they may be cheaper. And then there's discounts. So, such as having a discount for a good student. They figure if you do well in school, you might be more responsible, and that there's a better chance that you're going to be a safe driver. And then also drive less. The less you drive, the lower the risk it is that you may find yourself in an accident. And then moving, there's some areas where, depending on where you live, there's a smaller risk of getting into the accident, so that would decrease your cost of insurance as well. And then keeping your driving record clean is always going to help you to lower the cost of your insurance.